pleasure to introduce to you four very, and I sound like Nicholas Parsons at the beginning of just a minute, four very able speakers who will speak without hesitation, deviation, or repetition, although I suspect we might get all three. That's all right, doesn't matter. To my right is Melanie Gurlis, who is the art market editor of the Art newspaper, which I would recommend if you've never seen it. It's a very beautiful, high-quality production, and it's online as well. So I would urge you to have a read about that. She's also the author of Art as an Investment, ? A survey of comparative assets, which takes art and then compares it to equities and private equity and gold and things like that, and works out what it shares in common with all of them and what it doesn't. It's a good read. We serialised it in Spears in the last issue. Pick it up. Then to her right is Jonathan Fisher, who is the tax director of private client services at BDO, who are generously giving up their office to us today. He specialises in cross-border planning and family offices and structuring and holding luxury assets. I like to hold luxury assets, but in my hands, so no one can take them from me. Then to his right, we have Arup Ganguly, who is of KNG Securities, which is an independent fixed income specialist. He used to be at Goldman Sachs, as you will soon see. And finally, we have Vikram Goyal of Unesta Property, whose favourite saying on his website is, even the best can be made better, which we're going to prove today because we have the best panel and we're going to make them even better than they normally would be. He deals in wealth. He says wealth exchange is financial, intellectual and emotional. And indeed, I feel very emotional when I have to exchange some of my wealth for not going to jail with the tax man.
All luxury assets, so whether art or wine or high-end property or classic cars have been incredibly popular in recent years for the reasons that you probably know about much better than me, but there's much more wealth growing around the world at the top end. Other assets, I hope you don't mind me saying, but other alternative and traditional assets haven't been particularly wealth generating of late. But also I think art has become incredibly fashionable. Particularly contemporary art, which actually of all aspects of art, I mean, I'm here to say of all of those assets, art is the least secure, safe, and, wealth generating.
So as I said, it's classified as property v luxury assets. And I say the one thing about my luxury asset is it is not sometimes going to make you a lot of money. The average running cost is about 10% on build cost, okay? So if you're talking about 100 million euro yacht, you're talking about 10 million on average running cost a year, okay? What this is about, and it's not about just buying silly, okay? What is a real knack when actually building one of these assets or buying an asset, particularly a corporate jet, is actually buying right. It's all about downside protection. Everything about this asset class is about downside protection. Within the asset class itself, it has some very distinct characteristics, culturally and also from the buyer's perspective, okay? So what is a corporate jet? A corporate jet, in my experience, okay, is not really a purchase of passion, okay? A Blitz liner might be, but most corporate jets is not a purchase of passion. It is a purchase about lifestyle. It's a purchase about convenience. It's a purchase about business, okay? A lot of corporate jet owners, they want it for their business use and they want it for their corporate use, and the two are very intermixed.
You could buy Reliance paper at 40 cents on the dollar in our market. A year and a half later, you're selling it at 105, 110. So you're almost tripling your money within the space of a year. Unfortunately, the mid-caps never recovered. Their equities never recovered, and a lot of those bonds are actually in court and being restructured, etc. That explains why the market never really came back. And I know I have a lot of institutional investors who say to me, don't talk about India. I've lost too much money in India. It's an illiquid market. It's ill-governed. The SEBI keeps changing the rules. The RBI keeps changing the rules. When they change the rules, they never tell me about it. And I've lost a whole lot of money. So, it's unfortunately a problem. Peaking equity markets are good for convertible issuance, but not so good for the investor because they don't want to pay top dollar for convert bonds. So, that's a double-edged sword.
It's all about getting value for money today. It's all about getting the right project in terms of your aspirations in return on investment. So do you want to invest for capital returns? Do you want to invest for rental yields? So these two areas you have to very specifically identify. So coming back to your question, Mumbai, Delhi, yes, are always going to be the main I would say, cities' main driving factors. Because of the comfort factor, whenever we all global Indians, we go to India, we either land up in one of these cities or we have relatives or friends. So that brings a comfort factor. But real money, I would say, now is in tier 2 cities, because those cities are more value for money.